Welcome to FT Markets. Amid all the noise over US interest rates, there is a conflict for central bank policymakers at the heart of the debate. Falling unemployment tells them they should raise rates, while extremely subdued inflation tells them they should hold fire. We have John Rowe, Head of Multi-Asset Funds at Legal & General Investment Management, in the studio to discuss the dilemma. Welcome, John. Our first charts show US inflation and unemployment rates with US inflation expectations in 5 years' time. As you can see, everything's falling and the picture looks very subdued. That presumably makes it a very difficult decision for the Fed come December.
It's very, very difficult. You've had unemployment come down from around 10% to very close to where they feel the long-term rate is. And in fact, they've actually cut that long-term rate several times, their view of the long-term rate, almost to give themselves a bit more policy space. But unfortunately, inflation has just refused to pick up in the meantime. So all else equal, with unemployment at this level, they'd want to start to increase rates. You've got to remember that really, really low level. So they've got to try and get them back to more normal levels, not stay in such an extreme state for so long. But the problem they've got, of course, is that inflation is so low. And so on the one hand, they would really like to start to raise rates, because what they're worried about is if they keep being as accommodative as they're being, then what will happen is that the economy will overheat and you'll start to get the boom and bust, which is exactly what policymakers look to avoid.
Johnny, I mean, they have a twin policy of looking at employment and inflation. In this case, which is most important to them, do you think? Are they favouring making sure employment's coming down, or is it the worry on inflation?
I think they've answered that with their actions. It's the worry of inflation. It's the worry that you end up in a Japanese state with prolonged deflation. And the idea being that once you get into that scenario, it's very, very hard to get out. So what they're really worried about is not just the short-term interest rates, but those interest rate expectations, which you can see have just been drifting down over the last 5 years. And the reason that worries them is they need those anchored if they're going to achieve their dual mandate. So what they're effectively doing is deliberately stoking up the economy, almost trying to get it to go too fast, because they think it'll be easier to put the brakes on than find out they didn't put enough fire in it.
Excellent. Our second chart shows market rate expectations this time last year and today. As you can see by the red line, the market has become very dovish this year and is now expecting rates to rise next summer, according to Fed fund prices. Why is the market so dovish, and are they right to think that rates will remain on hold in December, particularly as a lot of economists and central bank policymakers themselves are forecasting a rate rise in 2 months?
I think that's a really good point. So first of all, there's the commodity kind of crash, and particularly oil, and lower commodity prices create a deflationary pressure which encourages people to stay on hold for longer. And that kind of started about a year ago, and so that's now built in. But we're now looking at Fed fund futures that suggest just 1 to 2 bank rate hikes next year, and so on and so forth for the next 3 or 4 years. And that does just feel too dovish. So just not enough expectation of interest rates. It's hard to imagine how an economy that's creating jobs at the kind of pace it is could stay on hold for that long. So what's really interesting is, does that mean people don't believe the Fed, or do they just not believe in economics? And they're two completely different things. In one side, you say, I still believe in economics, I still believe in the cycle, I just don't believe the Fed will hike. In the second, you say, there are such big global forces at work in a world where the UK's got 0 interest rates, Japan's got 0 interest rate, Europe's got negative interest rates, that effectively normal economics won't work. And almost the idea being that as they try and make this work, as they try and raise interest rates, they'll get sucked back into the mire by everybody else. And it's hard to tell which they're pointing towards, but the fact it's so dovish almost to me says they're questioning economics rather than the Fed's reaction function.
In that case, what's your call for December? Are you confident that there will be a rate rise?
So our economic call is that there will be a rate rise. So priced into markets is kind of 25–30% chance for rate hike, and our core case is a raise in December and then 4 more raises next year, followed by an acceleration in 2017. So we're banking more on traditional economics and on the Fed and on low unemployment and on the need to start to rise. On the flip side, we're cognizant of the fact that with inflation so low, there may be an incentive to leave things a little bit too long. Janet Yellen said back in September, October, that she was one of the 12 that was saying there would be a rate hike this year. Well, actually for her to change her mind would feel like a big change, and from that perspective it is quite surprising that markets doubt them quite so much.
Thank you, John. Over the next 2 months, as the data comes in, it will become clearer whether the US Federal Reserve will raise rates in December or not. At the moment, it could go either way, as central bankers and economists are divided and the market continues to price in a delay until next year.